Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to the calculation of asset turnover and return on equity trend analysis. So we'll be comparing multiple different years, taking a look at a trend analysis related to the asset turnover and return on equity. Get ready. It's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 337 Asset Turnover and Return on Equity Trend Analysis tab under the Practice Problems section. Closing this back up, we're going to have our information up top. That information is something we'll go over in total first, and then we'll take a look at components of it as we go through the practice problem. Information includes the years, X0, X1, X2, X3. We got our income statement number, which is going to be the bottom line of the income statement, net income. Then we have our balance sheet numbers, which are basically the totals of the balance sheet, which will correlate to the accounting equation, assets equal liabilities plus equity, that including total assets, total debt, and the stockholders' equity numbers. Okay, so going on down, we're going to take a look at the return on assets. Return on assets calculation, you'll recall, is the net income, bottom line of the income statement, performance number, compared to the total assets, balance sheet number, because we have an income statement timing activity statement, which has the beginning to the end time range, versus the balance sheet, which is as of a point in time. You might see this as net income divided by average total assets, most common average being the beginning of the period plus the end of the period divided by 2, giving us the return on assets. So if we start picking up these numbers for X0, we're going to say we have the 140,000 of the net income compared to the total assets of the 2,653,000. That's going to give us, if we divide that out, the 140,000 divided by the 2,653,000 gives us about 5.28. And let's just do the calculation just so we can practice moving the decimal on over. We're going to take the 140,000 divided by the 2,653,000. If we move the decimal over 2 places, we're at the 5.28 about. 5.28 about. This is a measure of how efficiently we're using our assets. So obviously we want this number to typically be higher. So if we were to net income, we would like net income to be increasing in relation to the total assets. So if net income goes up, then obviously the ratio would go up because that's the numerator. The denominator, you might say, wouldn't we want assets to go up too? We do want assets to go up, but the reason assets are going up is that we're going to use them in order to get a return on the assets. So assets going up without us being able to utilize them in the company to make a return isn't necessarily good, because we might be able to give those assets possibly to the owners or something like that, where they can invest somewhere else and get a return on it. So the point of us having the assets in the company is to get, a return on it. So we want this number to be higher typically. Let's see what happens in X1, where we now have the 143,000 compared to the total assets of the 2,298,000. So the income went up a little bit and the total assets went down. So what's that happen to the ratio? The ratio is going up. So if I divide the 143,000 divided by the 2,298,000, and then we move the decimal over, making it a percent, we got 6.22. So the ratio went up, and that's good. So note, why did it go up? Well, the numerator went up, but it didn't go up by that much. It just went up by like 3,000, not a whole lot. The denominator actually went down. So you might be saying, well, how can it be, how can it be good that the denominator went down? Well, again, it might be the case that now if we can get the same amount of revenue, in other words, for less assets, if the company has less assets on which they are earning the same amount of revenue, then that means we're using those assets more efficiently. That is good. And like I say, if we're not utilizing the assets, if the assets have no value in the company in terms of revenue generation, then it might be better for us to basically give those assets possibly to the owners in the form of dividends or something like that, right? And in doing so, if we could still keep the efficiency of the company because we're utilizing the assets well, then that would still be good. So notice this so we would want to then analyze further the major effect. Well, why did the assets go down? What was the cause of the decrease in the assets might be something we would then dig into. Notice you can also start to think about a trend analysis. You could say, all right, if I took the difference then the 6.22, if I did this in a 6.22 minus the 5.28, we've got a difference of about 95%. The reason it's 95 here is because of rounding, because we did this in Excel. So notice when you work with Excel, it's going to be calculating the entire number, even though it rounds it to 2 places. And I highly recommend working these problems in Excel and really getting used to understanding that rounding thing, because it really can bother some people, especially people that like things to be perfect, right? I want it to be perfect on the number, but there's going to be a rounding difference, and that's okay. Because remember, all these numbers are just ratios. They're trying to give us an idea of a picture that we can't really see. So we want to take the rounding to a point that it's going to give us a valuable, information. So the fact that it's not going to be perfect is part of something we just got to be okay with. So then we're going to take the next time period, which is going to be X2. So we'll take the net income divided by the assets, and we're going to get the 7.22. So notice this trend is good. It's an increasing trend. Now, also note, however, that in order to determine how good it would be, we would want to compare both the number amount that we are coming to as well as the trend, what's happening over time with industry standards, to see if we're kind of in alignment with what's going on in the industry as a whole, which would reflect, you would think, the economy in general. So now this is going up again. That's good. Why did it go up? Well, this time the net income went up a little bit more significantly. The numerator went up, and that would increase the ratio. That's good. And then the denominator went down as well. So now we have kind of a change on both sides of the equation. We're actually getting more income, which would indicate that we're using the assets that we have more efficiently. And it went up even though, once again, the assets have declined. If we take a look at the change, then we have a positive change as well, because it's an increasing change. So we have an increasing rise upwards. Okay, and then we've got the next item, which is going to be the 258 net income divided by the total assets, and that's going to give us a change of 9.77. Again, a positive change. Why did this happen? Well, this time the net income went up by a significant amount, more significant amount of an increase in the net income, and the total assets, instead of going down, increase. So the total assets increasing would decrease the ratio. The net income increasing would increase the ratio. So the net income increased the ratio at a higher rate than the fact that we increased the denominator would decrease the ratio. So the ratio still went up significantly, even though the denominator went up this time instead of going down. So now in this case, we're saying, okay, now the assets actually went up. So we increased the assets and we increased the net income. So that might be an indication that we invested in the company at this point, and we're able to now lock in how well we're going to use those assets in order to get a higher rate of return. And so, because before we had 263,000 of assets and we were only generating 140,000 of income. And then we actually lowered our assets and we're still getting the same amount of income. We lowered the assets again, income actually went up. And so, and this time now we invested, maybe we found out how to invest our assets, and we increased the assets again. And now we're actually getting the return that we would like to see on possibly the assets that we have. Maybe we're using them more efficiently or something like that, So in any case, the trend analysis is an increasing trend too. So if you look at the trend, this rate is going up, the ratio is going up, and it's going up at an increasing rate. The change is going up. So then if we go back down and say, okay, let's take a look at the return on stockholders' equity. So return on stockholders' equity. So remember the accounting equation, assets equal liabilities plus equity. Return on stockholders' equity is going to be comparing the net income to the stockholders' equity. Net income is going to be the performance document, once again, or the performance number on the income statement, bottom line of the income statement. Equity can be seen also as assets minus liabilities equal equity, which you can think of as kind of like the book value of the company. So that's what you could think of in another sense, like what the owners put in was what the owners put in plus the generation of earnings that haven't been distributed out, right? It's part of what the owners kind of have claim to, as compared to what third parties or liabilities debt has claim to. So the book value of the company. So that means if the equity, the less the equity is, then you're thinking about the return the net income on the equity portion or the book value of the company to kind of like the owners. So we got net income performance compared to the equity. We're looking at the return on stockholders' equity. So we got the 140,000 divided by the equity, which is the 794,000, 794. So if we divide that out, let's just do it here real quick. We've got the 140,000 divided by the 794,000. If we move the decimal over, we get the 17.63 about. So is that good or bad? You want to compare it to, again, industry standards and to ourselves to see whether or not that's a good return on equity. Also note, when you're thinking about the return on equity, you got to be considering the amount of leverage, the amount of liabilities as compared to equity that is in the company as well, to see how leveraged the company is, to have a better understanding of this calculation. So then we got the net income compared to the stockholders' equity for the second year, net income stockholders' equity. So what happens to our ratio if we take the 143,000 divided by the 128,700, we get the 11.11. We would like this ratio to be going up, but it's not going up, it's going down here. So now this is like what kind of a negative trend on the ratio. The decline rate was a 6.52 rate of decline. So we could compare this then both in terms of the solid number to industry standards. We can compare it to our prior performance, obviously, which means it looks like it's worse at this point. And we can compare the trend to the industry standard as well, which would mean the change that we have here. Now, then we would think, well, why did it go down? Well, net income went up, so you would think that would be increasing the return, but it only went up by a little bit. And then the stockholders' equity went way up. So stockholders' equity went way up, not just due to the net income. So why did so then we'd want to drill down in terms of why stockholders' equity went up. If you look at this, we're kind of comparing the stockholders' equity compared to the liabilities. You'll note that the stockholders' equity went way up, whereas the liabilities went down. So maybe investors invested in order to pay down some of the liability or something like that. In order to, and so you'd want to kind of explain actually why this happened. That might be one reason for the change. So once you find these changes, you kind of want to explain them and see if there's a rationale for the change. So then we got the net income in X2 compared to the stockholders' equity. And that's going to give us a decrease once again. The decrease at least is going down, so it's a lesser of a decrease. So it's going down. We don't really like that, but at least it's going down at a lesser rate at this point. Why is it going down? Well, net income is going up. So once again, you wouldn't think that it would be going down. But if you compare the stockholders' equity went up as well, it went up at a higher rate than the increase in the net income. So why is that? Well, again, if you look at the debt and the equity, you can see that the debt is going down and the equity is going up. So it might be that, again, investors might be putting money in to pay down basically the third-party liability, basically kind of deleveraging the loan, which may not be necessarily a bad thing, because again, if you talk about the assets that we have here, those assets are either they're claimed by a third party, meaning we got those assets basically from financing, or through equity, meaning the owners put them in, or through earnings that have been generated. And so you don't want the liability portion to be too high comparing debt to total assets. You don't want that to be too high because you'll be over leveraged. So the fact that this number is going down. So in other words, if the liabilities were higher, then that would make your equity lower. The book value would be lower because the owners would have invested less. So you'd be more leveraged in that case. And then any returns that you would have, the returns compared to the equity. So right, the returns compared to the equity would be lower. So your return compared to equity would be better under that case. But too much leverage can come with risk as well. So you got to consider the amount of risk. So it might be as to whether or not you deleverage or not when you're considering this ratio. So then lastly, we got the net income compared to the equity, stockholders' equity again. And once again, this time we have a bit of a decline on or again, another decline. So 17 to 11, a decline by a little bit more this time. So again, the downward trend is not good. If you compared it to the industry standard, you'd want to compare it to the industry standard and then say, why did it go down? Well, it looks like net income went up again. It went up fairly significantly. Stockholders' equity, but however, went significantly up as well. So then the question is, why did that happen? Once again, you can see the debt went down significantly and the stockholders' equity went up.